once again, Maverick Traders. It's the 2nd of August. It's Wednesday. Joe with you here. It seems like only yesterday I talked to you because I did talk to you yesterday. Let's talk about today, though. Big difference. I've got my 2 cents. You know the drill. Take responsibility for the outcome of what you get from this class. Make sure to follow your trading plan. What I want to do for this class is review some meaningful news, if any. And by the way, there was some. Let's take a look at it and how it impacted the markets. We're going to do a technical analysis from top to bottom, including a weekly and monthly outlook in the overall markets. Let's take a look at the sector heat map, see if anything has gone bad or good, because we are in the midst of earnings season. I've got a couple of trade setups as well when it comes to bullish, bearish, and sideways. Not a lot of sideways for this week, or for, I should say for today, but we'll take a look at those as such.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Moving into the market analysis, we can see a pretty different day than we've seen in the past. I'm just going to jump straight into the daily news. A U.S. credit rating downgraded by Fitch, a global financial analytical firm. We've seen this before. You can see that was a big impact. It's the lowest move since April, but we have seen a move off of our AAA rating before in the past. It was in 2011. We did have a Senate and Congress that was debating back and forth, and we're threatening a government shutdown, a government default of loans. So it's a very similar situation that we saw in 2011. So when I take a look at Fitch, you know, this analytical firm, it makes total sense. They're like, well, look, let's take a look at what's going on. We were in a lot of debt. We printed a lot of money. We're pretty extended when it comes to some of the financial prowesses of the United States itself, on top of which we have a Senate and Congress that are debating and fighting about extending expanding a credit ceiling. And if we don't do that, then we could be in line for a default, or I should say at risk for a default. So this can was kicked down the road. It's exactly almost very similar situation that we saw back in 2011, but it was enough to maybe shake the markets. Now I'm going to say it's conveniently shaking the markets, as this corresponds with a pretty great place to take profits regarding our technical levels and the move that we've seen since the beginning of this year. We're in a nice tight consolidation area, and when we get to the charts here, you're going to see that even with today's action, and you guys can see here, let me pull this up real quick, you can see that the VIX did participate. So it was a little bit of a slew, or I should say it did cause a little bit of a flight to safety and maybe some activity in some of the volatility, or excuse me, buying protective puts as we saw the VIX participate. Now this is just one day. This is just one day. So how did we fare? Let's just go straight over to how price action finished. The Dow down about 1%, the S&P 1.38%, the NASDAQ just over 2%, Russell's 1.3%, oil about 2%, and gold about 0.35. So overall, if you just kind of blur your eyes across everything, it was a reaction to a little bit of fear. Everything kind of got dinged a little bit. Now, whether that has anything to do with some sort of earnings or news events that happened that added insult to injury, or it's just the fact that, hey, here's a great time. I'm a little bit worried. I wanted to take profits, and this is the excuse to do so. I'm kind of going to chalk it up to that. We'll see here in a second. Take a look at the advanced decline line, 76% declining, 21% advancing, a bump below the 50-day moving average, 63% still holding on, 37% below. So even though it was a pretty good move to the downside, you'll see here in a second with the chart, as it gapped down, we're still in a pretty decent area. Let's jump into that chart. So here's the SPY. I'm going to zoom in here because I really want you guys to take a focus on the major support level that I'm actually looking at, and it's way back here in June. Now we have extended ourselves, and I put the 20, the 50, and the 200-day moving averages back on this chart because I want you to see how separated these things are and how they've been expanding with this move to the upside. Now today's a pretty good size volume. Yes, we definitely gapped down, and this is a very scary candle, blah, blah, blah. But we aren't even below the 20-day moving average for the day. This first line I drew is going to be your next major level of support. So you can see that there is a pretty good substantial move, or I should say cushion, for the SPY to go before this actually even threatens a relative, or I should say healthy, pullback. So as far as one day, there's no way I'm going to touch the bulls that I put on yesterday or talked about yesterday. Kind of nice being able to do these classes back to back, because what one day can change emotionally changes nothing technically. Now this is scary, it's ominous, it's big. We saw the VIX, it's down, but guess what? Technically, we're in no worse shape than than we would expect it to be in just a regular pullback. I don't like days like today, because I'd like to see 2 or 3 days pulling back to the level we're at here at 450. Instead, we got one big reactionary, scary day. Okay, let's move on to the Qs. You can see almost the exact same thing. It's just what it is. I'll draw this line. It's a little bit deeper. This one's right at the area. You can see that this was actually sloping lower. This has a whole lot more to give up based on the extension that we've seen in some of these massive moves in the AI craze since the beginning of the year. A lot of these stocks are up over a 150, 200%. So when you see a little bit of corrective action, this one is technically below the 20-day moving average. I drew a very aggressive support line, but take this in consideration, folks. We have a consolidation area here, right around the 367.5, let's call it, and we do have a pivot point here at the just below the 50-day moving average at about 362.5. So this does also have a little bit of a cushion to pull back. Look at the move, or the volume that participated in the reaction to the fear of a little bit of a extension, or a AAA rating going down to a AA plus. By the way, this is a small hiccup when it comes to just, hey, let's take a look at where the U.S. is when it comes to credit, and a lot of it has to do with the discontent, or the confusion, I should say, or the argument between the Senate and the Congress. Think about that. It's not that big of a deal. It's not like we have defaulted. It is the possibility of not being as credible as we have in the past. That's all this is. As we move into the heat map, you can see it was a sell-off across the board. Technology leading the way, communication services, some of these larger companies that have made some of these larger percentage moves in the past have had a pretty decent pullback, or were the quickest, I should say, or the most infected or impacted by the reaction of the worries of the credit rating to the U.S. This is one day. I really can't chalk it up past that. Overall, outside of communication services and technology and the financials, consumer cyclical, take a look at the second half here. I'm going to go ahead and see if I can't draw a line. But you'll see right from here over, it wasn't too bad. Industrials, real estate, energy, consumer defensive, healthcare, pretty much brown across the board. What was good was good, was bad, so on and so forth. It wasn't too much of the reactionary impact that we saw in some of the bigger companies and some of the darlings that have been leading this rally since the beginning of 2023. I'm not changing too much. At the 20-day moving average is the only thing I switched, and I went to a zero outlook because we're in the midst of a pullback. Notice my monthly outlook is still a +2 because I am still positive. I love correctionary action, because when we see correctionary action in the markets, it usually creates a nice pullback for me to get into some of the trades that I want to at a discounted rate, as long as the charts hold true. So I'm going to give, I went from, I believe, a +1 to a 0, and that was from yesterday to today. It's just because the pullback is happening, I'm a little cautious. I want to make sure that the pullback confirms and turns before I buy anything to the upside. However, since we're above moving averages and we haven't broken support levels, and the price action is where I want to see it, I am not going to pull my monthly outlook to a 0 or -1. I'm not afraid. This is a healthy corrective action. It's aggressive, it's fast, and it's based on some news. But overall, until I see something technically break, I am sticking with my outlook and very comfortable with some of the bullish trades that I've got on from last week and even yesterday. Totally fine. That being said, let's take a look at some of these. This is a lot of trades that I pulled from yesterday's class. This is the fun thing, part about being able to go from yesterday to today. And I added a few more. Now, a lot of these trades looked good yesterday, and they didn't confirm today because they had that corrective action that we saw in the markets, but none of them broke down. They're still in very good situations to confirm. We just got to be patient and wait for them. As far as the potential bear side, there is a couple more as well that popped up that I kind of like that are now on my radar. This is great about a market that corrects. We can see what's super weak and we can see what's super strong based on the reaction and the fear and the shakeup of a market. If you've got some bull trades that don't pull back as much, you found something that's outperforming. If you've got a bear trade that just falls apart and is abandoned, well, you found something that's underperforming. That's basically relative to what we're looking for. Now, I've got a couple of each. I'm just going to look at a bull and a bear. I liked Garmin on the bull side, and two things about this, and you guys have heard me tout this before. Whenever we're in earnings season, I have a problem buying before or dealing with a trade afterwards. In fact, I would prefer it afterwards once the earnings is out and I can see price action, or I should say what the public does with it. Now, Garmin came out, looks like they beat their numbers or whatever's going on. I don't care because they seem like they're favorable. Today is not the day to buy it. Tomorrow might be a little bit more hesitant. I hope this thing doesn't gap up. But what I'm looking at is a beautiful resistance level that I don't have to worry about because we could see that these markets, or I should say the traders, have taken care of it. So I'm going to put my green line here at about 108. If you want to get more technical, whatever this high was, let's go above that. 108.47, you want to call it 108.5, 109, that's great. But look at the volume increase to the upside. I know that there's buying potential in this. Even if it gaps up to 110, keep an eye on this. Draw some Fibonacci lines, do a channel trend if you'd like to, and see if you can't target a little bit further to the upside. What I like about these stocks is the news is out. People either love it or hate it, and if they love it, I'm okay buying it because this is a nice pattern showing an ascending triangle breakout to the upside. Buying it today would have been very difficult. You can see where this low and this high was, and you can see where it opened and closed. That's a big range. But letting this bleed higher or continue its move after the fact, this becomes a little bit easier to trade. The volatility will drop, so should the spread of the options. So I do like Garmin to the upside. I'm going to go straight down to the bear side. This is Chewy. This thing popped up on the Wednesday class that Rob did last week. Again, on yesterday, I put it up there as a potential bear. But what I like about it is we had a bearish move today, didn't we? And guess what happened? This did roll over. Now, it quite didn't confirm the aggressiveness I want to see to the downside. In fact, folks, I'm going to include this $32 level as an area I'd really like to see it slide through and move its way down towards 30. But it is in a nice area. It's on its way down, 3.4% today. For you guys that are worried about the lower dollar stocks, you don't need to have much movement to get a good return on stocks like this. So if this does decide to bleed lower, if we do get a market that wants to continue to correct, this is a one-day reaction to a bad news, but I think the markets were looking for an excuse to just sell off. Here it is. We could see this slide over the next few days all the way back down to that 30 support. So diagonal targeted butterflies, something like that. Okay, so that's what I got. It's crazy how yesterday was, you know what, we're tired, the markets are overextended, but I'm not going to go super bearish. I want you to know that today I'm still not going bearish. I'm not going to abandon any of my bulls, regardless of what happened. You guys saw that we did gap down, but we are still above support levels. We are still in an uptrend. We're still above moving averages. So don't freak out about anything you bought yesterday. Just keep an eye on it, follow your rules. We do have instability with the U.S. credit rating. One of the firms out there, right? It's Fitch. It's just one firm. They're analytical. But it was enough to really shake a tree and have people take a step back and realize, okay, I forgot. We did get into a default scenario where the Senate and Congress were fighting back and forth, and we kicked the can down the road, although we are at 2.6 GDP. So it's really difficult to see anything bearish, but that is a concern to raise, or I should say to drop from a AAA to a AA plus. That's like going from an A to an A minus. Right? I think the markets might have overreacted. So let's take a look at what the reaction is going to be in the following days. It's really hard to gauge off of one day. You saw the VIX. We spiked up, but it's not like we spiked up over 20. Let's see what happens in the subsequent days. Does this create a reason to sell, take profits? Absolutely it does. I believe that's what this is. I think everybody was waiting to hit that cash register, and they're going to. How long they do it, we're going to find out. ADP employment was incredibly strong. This is one that snuck in. It was almost double the expected move of 175K jobs at 324, just showing that this is a very strong economy that shows that it's not going to slow down. If we can keep inflation flat, or at least pared off or slow, then we're going to have, I don't want to scare it away, folks, a soft landing, which would be one of the rare soft landings that we've seen in our history. But let's just not fight it. Jobless claims, ISM services, and non-farm payrolls. I talked about that yesterday. Guess what? It's going to happen today and tomorrow and the next day. Qualcomm, PayPal, and Shopify are the ones that I thought were interesting. Let me take a look here, folks. As of right now, Qualcomm's down about 4%, PayPal's down about 7.5%, and Shopify was down and is back up about 1%, kind of flat. So, hey, take a look at where those earnings go. It is just basically what people do with them. Keep that in mind. No matter what you expect or what the numbers say, it's what we do, or I should say the public does, with the price action. All right, folks, once again, 2 days in a row. Nice to chat with you again, and we'll talk to you next time. Bye, folks.